Hello, 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 hello. Okay. Think we're live. Okay. Yeah, we're good, we're good. Alright, so another day, another stream. We are going to close all these tabs. That's all I really want to do is close all these tabs. So yesterday we saw expense ratio is a measure of funds assets used for administrative or other operating expenses. So usually it's in the decimals. Assets under management is the total market value of the investments that a person or entity manages on behalf of clients. The larger the AUM, the more liquid the fund is. Net asset value is assets minus liabilities divided by total number of outstanding shares. The Nasdaq 100 is much more biased towards the technology sector in comparison to S&P 500. This has led to greater returns within the past decade. The rising wave of the AI revolution could possibly continue Nasdaq's favorability over S&P 500. Oopsie, my bad. Okay. An open-end fund can issue an unlimited number of shares, does not trade on exchanges, and is priced each day at the close of trading at their NAV price. Most mutual funds, such as those in 401k plans, are open-end funds. Closed-end funds are listed on a stock exchange, trade similarly to securities, and can trade at a price that's not equal to their NAV. ETFs trade like stocks, and their market value can differ from their actual NAV. Fund shares trading higher than their NAVs are trading at a premium, anticipating higher projections, while trading lower than their NAVs mean trading at a discount, anticipating lower projections. Index funds, which are passively managed funds, typically carry very low expense companies as potential investments. Those additional costs are passed on to shareholders in the form of higher expense ratios. Customized tracker funds still seek to track a predefined market index, but they provide for much more targeted investment, offering relatively low costs for investors. They are able to keep overall fund expenses lower by continuing to use an index replication strategy while getting many of the benefits of active fund management through screened indexes. Okay. So it's time for a new doc. This thing again, dude. I don't understand. All right, we could rock with that. So if we finished with customized tracker funds, let's do market capitalization. We already reviewed this before, but we'll just go through it real quick again. So market capitalization refers to the total dollar market value of a company's outstanding shares of stock. The investment community uses this figure to determine a company's size instead of sales or total asset figures. In an acquisition, the market cap is used to determine whether a takeover candidate represents a good value or not to the acquirer. Firstly, how much a company is worth is determined by the stock market. It is defined as the total market value of all outstanding shares. To calculate a company's market cap, multiply the number of outstanding shares by the current market value of one share. Companies are typically divided according to market capitalization. Large cap is 10 billion or more, mid cap is 2 billion to 10 billion, and small cap is 300 mil to 2 bill. Market cap is often used to determine a company's size, then evaluate the company's financial performance to other companies of various sizes. In investing, companies with larger market capitalization are often safer investments as they represent more established companies with generally longer history in business. True.
There's a city in the heart of South Carolina where you can recharge, reconnect, or relax.
I love experiencing the energy in Columbia. You can really tailor your Columbia experience.
Make plans for your next great escape to Columbia, South Carolina.
Columbia, South Carolina.
Market cap is simply the amount of money that investors have given to a company through the price of their shares. You find out the market cap by taking the number of outstanding shares and multiplying that number by the current price of the stock. So if there were 1 billion shares of the stock to trade and it was trading for $10 a share, the market cap of that company would be $10 billion.
Okay. Sorry. Understanding market capitalization. Understanding what a company is worth is an important task and often difficult to quickly and accurately ascertain. Market capitalization is a quick and easy method for estimating a company's value by extrapolating what the market thinks it is worth for publicly traded companies. In such a case, simply multiply the share price by the number of available shares. After a company goes public and starts trading on the exchange, its price is determined by supply and demand for its shares on the market. If there's a high demand for its shares due to favorable factors, the price would increase. If the company's future growth or potential doesn't look good, sellers of the stock can drive down its price. The market cap then becomes a real-time estimate of the company's value. Important. One company's share price may be 50, another company's share price may be 100. This does not mean the second price is twice as large as the first company. Always remember to factor in the number of shares issued, thereby analyze the company's total market cap when analyzing securities. Well, that makes me beg the question, why do some securities trade at higher values than others? A company splits its shares every time it reaches the $100 mark. Investors will always be able to buy the stock at a cheap price, no matter how large the company becomes. The most expensive dollar value of a stock today. Why does Berkshire Hathaway Right, so he's seeing it as an investment. So I'm gonna get a drink, but essentially Warren Buffett sees his shareholders as long-term. He wants them to be long-term investors. So because of that, he does not. Damn it! I'm out of ice. Oh, oh no! I have an ice cube. One singular ice cube is about to bring me so much joy in this world. So he does not want to split the stock because splitting the stock makes the stock more liquid. Making the stock more liquid means making the stock easier to trade, and he does not want that. Why does he want? Why would he want his stock easier to trade? This is an investment. This is his shareholder is in for the long run. So he is not here. Let me just refill this ice real quick. So he's not interested in splitting the price. So that makes sense to me right now. What doesn't, well, for at least Berkshire, but is that the case for everybody else on the list? I'm curious. So NVR. Oh my God, you can see it's in a different league, dude. It's in a completely different league. 5,000 to compared to 500,000. Why does NVR not split? Why is NVR stock so high? Home building, mortgage banking. I don't know. See, this is a great question to ask. Chipotle trades at 2,000. Highest market cap companies today. $172. See, why is Microsoft stock more expensive than Apple? Okay, no one explaining it. The thing I want to go to, this is cool, but the thing I want to go to back, I think it was right here. For example, a company with 20 million shares selling at $100 a share would have a market cap of $2 billion. A second company with only 10,000 would have a market cap of 10 mil. Gotcha. Oh my God. Company's market cap is first established via an IPO. Before an IPO, the company that wishes to go public enlists an investment bank to employ valuation techniques to derive a company's value and to determine how many shares will be offered to the public and at what price. For example, a company whose IPO value is set at 100 mil by its investment bank may decide to issue 10 million shares at $10 per day, $10 per share, or they may equivalently want to issue 20 million at $5 a share. So it's offering the shares of a private corporation to the public for the first time. important time for private investors to fully realize gains from their investment, as it typically includes a share premium. Okay, let me just get this definition down. Refers to the process of offering shares of a private to the public in a new stock issuance. Companies must meet requirements by SEC to hold an IPO. IPOs provide companies with an opportunity to obtain capital by offering shares to the primary market. Companies hire investment banks to market gauge demand, set the IPO price and date, and more. An IPO can be seen as an exit strategy for the company's founders and early investors, realizing the full profit from their private investment.
There's a city in the heart of South Carolina where you can recharge, reconnect, or relax.
I love experiencing the energy in Columbia. You can really tailor your Columbia experience.
Make plans for your next great escape to Columbia, South Carolina.
If you want live music, amazing record stores, some of the best restaurants.
Dude, I think we gotta go to Columbia, South Carolina, man. Sounds incredible. I mean, come on. Experience Columbia. Yes, sir.
So let's talk about the IPO process, which is the initial public offering process. And so what is it? The IPO process is when you start a company and you've raised money, friends and family, and now you've built this idea and you've built this product, but now you need to grow it. So how do you do that? You have to raise money. You've got to raise capital, and you do it through raising equity in the IPO process. So you're going to take your idea, you're going to take your company to an investment bank, you're going to sell them on your idea, you're going to tell them why this is such a great product. They're going to buy this story, they're going to refine the story, then they're going to take you around the country, and you're going to sell this story to institutional investors, to people who are going to be interested in investing money in this idea, in this product, to help bring you to the public markets. And so that's what the investment bank will do, is once they sell this story and they go around and they create and generate all this interest, they will do this process called the book building process. And then they'll start to take indications of interest from all the institutions. Okay, at $20, what are you willing to buy? At $12, what are you willing to buy? At $10, what are you willing to buy? And so that's called the book building process, and they'll get indications of interest from all these institutions around the country, and they'll build a book of interest. Once they build that book of interest and they realize how many shares are you bringing to the market for sale, you might be bringing 20 million shares to the market for sale. And so what they'll do, that's called supply, and then there's the demand. And what they'll do is they'll pair off until supply equals demand, and they'll figure out a price. Maybe it's $17 a share where there's 20 million shares to buy, and now you've got 20 million for sale, and that's the price, $17. And so they price your stock on Monday night at $17 a share. They put it out to the world. They give all these institutions the stock that they bought at that price. And then the next morning, you will come here to the New York Stock Exchange, where the IPO process will finally come to fruition. You'll show up here at 8 o'clock. You'll go upstairs to the 7th floor. You'll do all the breakfast and the pomp and circumstance. You'll learn all about the history here at the New York Stock Exchange. You'll come down here at 9:15. You'll go underneath the bell podium. You'll take pictures under the podium. You'll sign the book, and then you'll make your way up to the podium. You'll ring the opening bell, which is one of the most amazing things that you could ever.
This is not like ordinary. This is rare, dude. How many companies are IPO? 6,000 between 2000 and 2023. Bro, we beat it by 500. What? Wait, in the year 2020? Oh wow, so it's never mind. So it's just like, how many NBA players have there been ever? so it's like it's like twice as common than to be an NBA player. There's definitely more people that play basketball than there are companies. So it's like a big deal, but it's not.
Do in this country for people that have never done it and you can only watch it. Let me tell you, it is an amazing, amazing event. Then you'll come back down to the floor. You'll go over to your designated market maker, a designated market maker that you alone have interviewed, that you alone have chosen to be the one to represent your company here at the New York Stock Exchange. Then that same book building process now happens again, because today is the day where your company is going to go public. Today is the day where your company is going to be open to anybody in the world to be able to buy and sell shares of your company. And so the process will build. What's the interest? All of a sudden there's 1 million shares of demand for your stock. There could be 1 million shares to buy at $17 where it was priced. There could be people willing to pay $20 for up to 1 million shares because they didn't get a chance or they didn't buy enough on the IPO process, but they love this idea and this company that they want to commit more cash to your stock. And so therefore that process happens. That book building process once again happens here at the New York Stock Exchange, where supply will equal demand. And at some point you'll figure out, and they figure it out very efficiently, that all of a sudden there's 1 million shares to buy as high as $20. Well, now you have to ask, who's going to sell that stock, because it hasn't traded yet. And so they go back to the people that bought it last night at $17, and they say, listen, up 3 points, you could sell some stock. You bought it last night at 17, you could sell some of that position at 20, and they end up generating interest from the people that bought the stock the night before. And that process happens because it gets very well publicized. It's out there. Everyone's keenly interested in this name, in this stock, in this opportunity. And then once they figure out where supply equals demand, once again, so say it's at $20, they'll freeze the book, they'll ring the bell, they'll open the book, and the stock will start trading. And once it starts trading, it'll trade like every other stock here in the New York Stock Exchange. It'll trade electronically, it'll be efficient, it'll be seamless, and the retail public as well as the institutional will be able to interact in the system to buy and sell your stock. And that's how the IPO process happens.
Well, that's okay. So before an IPO, a company is considered private. As a pre-IPO private company, the business has grown with a relatively small number of shareholders, including early investors like founders, family, and friends, along with professional investors such as ventures capitalists and angel investors. Oh my God, here are some more definitions. What are venture capitalists? It is a private equity investor that provides capital to companies with high growth potential in exchange for an equity stake. A venture capitalist is a private that provides capital to companies with high growth. A VC investment could involve funding startup ventures or supporting small companies that wish to expand and have no access to the equities market. By the equities market. Okay. So I will make a note of that. We gotta put on the put on the music back, dude. So also, what is equity again? Represents the shareholder's stake in the company. Okay, so I've got shares. Let's say I got 20 shares. That 20 shares is my equity. Okay, gotcha. VC investment could involve startup as an investor. Also, let's just do that. Why is this so weird? I don't know. It provides young companies with the capital in exchange for equity. Startups often turn to VCs for the funding to scale and commercialize their products. Due to the uncertainties of investing in unproven companies, venture capitalists tend to experience high rates of failure. Huh. The rewards are substantial for those that well-known venture capitalists are Jim Breyer, bro. Why you gotta stop with the terms, please? I have 20 tabs open. I can't say.
Venture capital investment firms can provide the seed money for high-risk startup companies. People called venture capitalists run these firms and make the investment decisions. Besides money, venture capitalists can also provide support through advice, human resource management, and even office space for a business they invest in. Because of the high failure rate for most startup businesses, venture capitalists command a high rate of return for their investment. So what do entrepreneurs pay venture capitalists for receiving their investment? It's typically a piece of the startup company in the form of stock ownership. In addition, venture capitalists often receive a seat on the company's board of directors. Then how do venture capitalists get entrepreneurs to willingly give up a part of their companies, as well as some control over business decisions? Why not just go to a bank for a loan? The answer is because venture capitalists have money and they're willing to spend it. Conventional banks frequently shun loans to new businesses because, as mentioned earlier, these companies tend to have a high rate of failure. In addition, their owners usually lack loan collateral, so getting money from a venture capitalist is frequently the only way an entrepreneur can fund the business's growth. In the end, the venture capitalist's goal is for the business to achieve success. This could lead to the business having a public offering of its stock, which in turn would make the shareholding venture capitalist and the company founders a lot of money. Some venture capitalist firms are even public themselves and are included in some exchanges. This can provide an avenue for regular investors to also invest in ideas from entrepreneurs.
Okay. Usually formed as limited partnerships where the partner invests in the VC fund. A partnership made up of two or more partners in which the general partner oversees and runs the business while limited partners do not partake in managing the business. Bro, I'm not even including this if it's not. Partnership made up of two or more partners. The general partner oversees and runs the business while limited partners do not partake in managing the business. liable up to the amount of the investment. An LP is defined as having limited partners and a general partner, which has
There's a city in the heart of...
How many limited partnerships are there?
A limited partnership involves two or more partners conducting a business, but one is only liable for his capital investment. They are also called silent partnerships or limited liability partnerships. Suppose John invests money in Joe's ice cream shop. The money helps Joe pay his staff and maintain equipment. John does nothing to help run the ice cream shop, but he receives a monthly share of its profits. Therefore, John is earning a passive income from the ice cream shop. Joe keeps John updated on the shop's finances and status, but expects nothing more from him. John's investment risk is the chance Joe's ice cream shop fails and his investment receives no profit. John is not liable if Joe's ice cream shop racks up debt when all its trucks break down on the same day. When not liable if Joe's ice cream shop racks up debt when all its trucks break down on the
Gotcha.
same day. A limited partnership involves two or more partners conducting a... They are also liability investment. They are also called silent partnerships or limited liability.
Flexible, legal, and tax entity that allows partners to benefit from economies of scale. Economies of scale. They benefit from economies of scale, man. They benefit from economies of scale. Economies of scale are cost advantages reaped by companies when production becomes efficient. Companies can achieve economies of scale by increasing production and lowering costs. This happens because costs are spread over a large number of goods. Costs can be both fixed and variable. Economies of scale are cost advantages companies experience when production becomes efficient, as costs can be spread over a large amount of goods. A business's size is related to whether it can achieve an economy of scale. Large companies will have more cost savings and higher production levels. Economies of scale can be both internal and external. Internal economies are caused by factors within a single company, while external factors affect the entire industry. We're going to Colombia again, dude. The size of the business generally matters when it comes to the economies of scale. The larger the business, the more the cost savings. The larger the business, the more the cost savings. The economies of scale can be both internal and external. Internal economies of scale are based on management decisions, while external ones have to do with outside factors. Right, which is what we just read.
The term economies of scale is a key concept for any business in any industry. It's also important for consumers trying to understand why smaller businesses may have to charge more for similar products made by larger companies. Overall, economies of scale means that production becomes more efficient as the number of goods being produced increases. In most cases, companies that achieve economies of scale lower the average cost of their products by increasing production. That's because fixed costs that are needed to produce the product are spread out over a larger number of goods. In economies of scale, the cost of each product can depend on the size of the industry or on the size of an individual company. If there are a number of companies providing similar products within the same industry, the industry as a whole will dictate the cost of each product. In other cases, the cost per unit depends on how much of a product a company can produce. For big companies, this can be especially advantageous because it gives them access to a larger market. For small to medium-sized companies, increasing production can actually raise costs.
Interesting, okay. Internal functions include accounting, information technology, and marketing, which are also considered operational efficiencies and synergies. Ah, okay. Economies of scale are an important concept for any business in any industry and represent the cost savings and competitive advantages larger businesses have over smaller ones. Most consumers don't understand why a smaller business charges more for a similar product sold by a larger company. That's because the cost per unit depends on how much the company produces. Larger companies can produce more by spreading the cost of production over a large amount of goods. An industry may also be able to dictate the cost of a product if several different companies are producing similar goods within that industry. There are several reasons why economies of scale give rise to lower per unit costs. First, specialization of labor and more integrated technology boosts production volumes. Second, lower per unit costs can come from bulk orders from suppliers, larger advertising buys, or lower costs of capital. Oh my God, Jesus, man. Oh, cost of capital represents the return a company needs to achieve in order to justify the cost of capital projects, such as purchasing new equipment or constructing a new building. Cost of capital encompasses the cost of both equity and debt, weighted according to the company's preferred or existing capital structure. This is known as the weighted average cost capital. Company's investment decisions for new projects should always generate a return that exceeds the firm's cost of the capital used for
There's a city.
Product will not generate a return for investors. Dude, you like to just mess around.
Cost of capital is the cost of funds used to finance a business. Typically, corporations obtain financing through a combination of issuing equity in the form of shares and by taking on debt through borrowing from banks or issuing bonds. The people who provide a company with its capital also want to earn a return on their investment. Combined, those factors comprise a company's overall cost of capital. The cost of debt is the interest a company pays. The cost of equity is the compensation investors demand in exchange for owning a company's shares. The overall cost of capital is the weighted average of a company's capital sources, also known as the weighted average cost of capital, or WACC. The cost of capital is used to discount future cash flows from potential projects and estimate their net present value. Companies want an optimal financing mix. Debt has tax advantages over equity financing, but too much debt results in high leverage, leading to high interest rates to compensate lenders for the risk of higher default. Businesses use cost of capital to analyze whether or not to proceed with a project. As long as the cost of capital is below the rate of return that the company earns by using its capital, it's a good investment. If the capital needed to make money exceeds the amount of money the capital will generate, it's a bad investment.
Oh my god, I did not understand any of that. Understanding a company embarking on a major must know how much money the project will have to generate in order to offset the cost of undertaking it and then continue to generate profits from the company. I'm just gonna take that and I'm gonna leave. Because I do not know what that dude is talking about, or that woman. Just I have no clue. Okay, we are going to leave it there. This will be visited in the future. There are two different types of economies of scale. Internal economies of scale originate within the company to change how the product, rather than a single company. Internal economies of scale happen when a company cut costs internally, so they're unique to that particular firm. This may be the result of sheer size of a company or because of decisions for the firm's management. There are different kinds of internal economies of scale. These include technical large-scale machines or production processes that increase productivity. Purchasing discounts on cost due to purchasing in bulk. True. Managerial, employing specialists to oversee and improve different parts of the production process. Risk-bearing, spreading risks out across multiple investors. Financial, higher credit worthiness, which increases access to capital and more favorable interest rates. Marketing, more advertising power spread across, as well as positioning in the market to negotiate. Larger companies are often able to achieve internal economies of scale, lowering their costs and raising their production levels because they can, for example, buy resources in bulk, have a patent or special technology, or access more capital. External economies of scale, on the other hand, are achieved because of external factors or factors that affect an industry. That means no one company controls costs on its own. These occur when there is a highly skilled labor pool, subsidies and or tax reductions, and joint ventures. Anything cut down to many companies in a specific. Management techniques and technology have been focusing on limits to economies of scale for decades. Setup costs are lower due to more flexible technology. Equipment is priced more closely to match production. Ah. Okay, so obviously you try. So obviously the people that are employing, so the managers that are employing their skills, or the manufacturers that are supplying these machinery that are incredibly productive, they're obviously trying to price their labor or their product in a manner to limit the economies of scale. Because okay, if I made this product for like, the labor cost is like 400 for this product, and I gave it to you, and you're making like millions off of this, all right, I'm gonna tax you a bit. I'm not gonna tax you 400. This might be 4,000 because I just know how much money you will make off of this. So then they are therefore trying to limit economies of scale. That's the whole goal of that level of supply, the suppliers. Outsourcing functional services make costs more similar across businesses of various sizes. These functional services include accounting, human resources, marketing, treasury, legal, and information technology. Micromanufacturing, hyperlocal manufacturing, and additive manufacturing can lower both setup and production costs. Global trade and logistics have contributed to lower costs regardless of the size of an individual plant. According to the International Monetary Fund, the prices of both capital goods and the cost of machinery and equipment have been falling in emerging, developed, and even industrial countries for the past 3 decades. In a hospital, it is still a 20-minute visit with a doctor, but all the business overhead costs of the hospital visit are spread across more doctor visits, and the person assisting the doctor is no longer a degreed nurse, but a technician or nursing aide. Job shops produce products in groups such as shirts with your company logo. A significant element of the cost of the setup in job shops, larger production runs lower unit costs because the setup costs are designing the logo and creating the silk pattern are spread across more shirts. Okay, so I kind of get this. Thank you. Awesome. Everything is awesome.
Larger market.
I did not understand capital. I just wrote it down. I don't understand it. But that's whatever. It is what it is. I'll just be happy if I get the same tab count that I had last time. So, limited liability partnership. Limited liability partnerships are a flexible legal and tax entity that allows partners to benefit from economies of scale by working together while also reducing their liability for the actions of other partners. As with any legal entity, it is important that you check the laws in your nation before getting too excited. In short, check with a lawyer first. The chances are good that they have first-hand experience with an LLP. Limited liability partnerships allow for a partnership structure where each partner's liabilities are limited to the amount they put into the business. Having business partners means spreading the risk, leveraging individual skills and expertise, and establishing division of labor. Limited liability means if the partnership fails, then creditors cannot go after a partner's personal assets or income. LLPs are common in professional businesses like law firms, accounting firms, medical practices, and wealth managers.
There
Limited liability partnerships, also known as LLPs, are flexible legal and tax entities that allow partners to benefit from economies of scale by pooling resources. LLPs are everywhere. You've probably seen legal and accounting offices with LLP after a list of names, such as Hauser, Hunter & Smith, LLP. LLPs also let partners work together while reducing their liability for the actions of the other partners. The written partnership agreement in an LLP usually comes with annual reporting requirements. The rules can vary from state to state, so check with a lawyer in your area for your local region. Generally, limited liability means that if a partnership fails, creditors cannot go after a partner's personal assets or income. Having business partners helps a business spread risk, leverage individual expertise, and establish a clear division of labor. And LLPs are structured so that each partner's liabilities are limited to the amount that they put into the business. They also help reduce costs by pooling resources while protecting the reputations of the individual partners. Limited liability partnerships can be found all over the world. They exist in many countries with a variety of differences from the US model. But in most countries, an LLP is a tax flow-through entity intended for professionals who all have an active role in managing the partnership as a whole.
Okay. Oh, it gives you like a little profile. Nice. Flexible legal and tax entity that allows benefits to benefit from by working together and also reducing. To understand an LLP, it is best to start with the general partnership. A general partnership is a for-profit entity that is created by a mutual understanding between two or more parties. This is a very technical way of describing two or more people working together to make money. A general partnership can be quite informal. All it takes is a shared interest, perhaps a written contract, and a handshake. Of course, with the informal nature of a general partnership, there is a downside. The most obvious risk is that of legal liability. In a general partnership, all partners share liability for any issue that may arise. For example, if Joanne and Ted are partners in a cupcake venture, and a bad batch results in people getting sick, they can both be personally sued for damages. For this reason, many people quickly turn general partnerships into formal legal entities to protect personal assets from being part of any lawsuit. The actual details of an LLP depend on where you create it. In general, however, your personal assets as a partner are protected from legal action. Basically, the liability is limited in the sense that you may lose assets in the partnership, but not those outside it, your personal. A limited liability partnership and a limited liability company both offer protections for their owners. The LLP is a formal structure that requires a written partnership agreement that usually comes with annual reporting requirements depending on your legal jurisdiction. It differs from an LLC in its liability protections, however, as well as management requirements. LLC has more flexibility in who can manage the business. LLP's required management duties be equally divided. Protection-wise, LLCs protect members from personal liability for debts or claims on the business. With an LLP, a partner is not liable for another partner's mistakes. Overall, it is the flexibility of an LLP for a certain type of professional that makes it superior option to an LLC or other corporate entity. Like an LLC, the LLP is a flow-through entity for tax purposes. I don't know what a flow-through entity means. This means that the partners receive untaxed profits and must pay the taxes themselves. Preferable to a corporation, which is taxed as an entity and its shareholders taxed again. As in a general partnership, all partners in an LLP can participate in the management of the partnership. This is an important point because there is another type of partnership, a limited partner, in which one partner knows as the general has all the power and most of the liability, and the other partner are silent. Damn, I wanted to close tabs, but I opened more tabs. Isn't that ironic? I just want to compare it right now to the Yeah, I'm getting there. I'm getting there. I think I'm gonna wrap it up right here. Just with one more sentence about limited. Tends to rely heavily on their reputation. Most LLPs are created and managed by a group of friends who have a lot of experience and clients among them. Oh, I don't think I called the other one. I should call this something. We'll call it nav. I want to go to the bottom of the page. That's what I'll do. But I got what an LLP is. Okay, this one, and then alright, I think that is all we're gonna do today. It's a pretty short stream, it was like an hour, but I had so much stuff to write. And I kind of want to end it because I kind of want to go work out, so. Thank you guys. Goodbye. There's a lot of information.